Welcome back to the Deep Dive, the shortcut to being well-informed. Today we're cracking open the Q3 2025 earnings call for Omnicom Group, that's OMC. And this was a quarter that, on the surface, looked pretty good financially, but it was just completely overshadowed by strategy.
It really was. If you were listening to that call, you could almost feel the tension. I mean, OMC reported a solid consensus beat, yet the entire conversation was just dominated by this approaching massive Interpublic Group acquisition.
The IPG deal.
Yeah. So this wasn't just a report about the last 90 days. It was more of a necessary beat and reposition quarter. They had to deliver the numbers to show the core business is healthy, while also detailing all the heavy lifting they're doing to make this deal happen.
And the market reaction tells that story perfectly, doesn't it? Despite that beat, the stock was, well, tepid. It dipped a little in after-hours trading. It's just so clear that investors are looking straight past the Q3 success and right into the execution risk, the integration headaches, the costs.
They're demanding proof. They want to see the synergy story. And right now, all they see are the costs. And, Q3 was the quarter where management basically proved those costs aren't hypothetical. They are very, very real, and they are hitting the margins right now.
Okay, let's unpack this. Let's start with a snapshot of the high-level numbers that drove that beat before we dive into all the integration details. What did OMC deliver on the headlines?
So performance was strong on both the top and bottom lines. Non-GAAP adjusted EPS, that came in at $2.24.
And that beat consensus by how much?
By a pretty significant margin, actually, about 7 to 8 cents. Total revenue was $4.04 billion, which also edged out what the analysts were expecting.
And what about that all-important organic growth number, the one that tells us about the health of the underlying business?
Organic revenue growth was up 2.6% for the quarter. And what's crucial there is that it keeps their 9-month year-to-date organic growth right at 3%. Management reaffirmed that's in line with their full-year guidance, which suggests stability.
So a clean financial beat. But this is where we need to dive into the income statement, because this is the tension point the market is reacting to. They're prepping for the IPG deal. Yeah, and those costs are already creating drag.
This is the crux of it. This is the whole bear case right now. You have to look at two different margin metrics to see what's happening. First, you've got the clean operating metric, the adjusted EBITDA margin. That one actually grew a little bit to 16.1%.
Okay, so up 10 basis points year over year. That suggests the core business, the agencies, they're holding up just fine.
Exactly. But then you look at the GAAP operating margin, and it tells a completely different and, frankly, a much more painful story. This is where the price of this transformation really shows up.
How bad was it?
It was a pretty steep decline. It fell 240 basis points year over year, down to 13.1%. And management was crystal clear about why. This compression was directly driven by nearly $100 million in one-time charges.
$100 million.
Wow. Yeah. Specifically, $60.8 million was acquisition-related expenses, and then another $38.6 million was for repositioning costs, which is mostly severance.
So that's nearly $100 million in hard costs hitting the sheet in just one quarter. That severance number, in particular, that signals a real commitment to cutting overlap fast. It sounds like they're taking the medicine now, so the unified company is leaner from day one.
That's the strategic takeaway, 100%. They're paying upfront for future scale. They're accepting this short-term margin pain to prepare the ground for the massive synergies they're promising for 2026.
Sure, but the market hates that pain.
Of course it does. But the alternative, a slow, drawn-out integration, that would probably be way worse for shareholder value in the long run.
So given that heavy cost commitment, let's talk about the final stretch of the merger itself. When does this thing actually close? When does it become real?
The timeline is pretty firm now. Management said they expect the acquisition to close in late November. The regulatory hurdles are almost all cleared. They've got antitrust clearance from everywhere except the European Union, and that final EU filing was just submitted on October 20th.
And despite this immediate margin hit, management still sounds incredibly bullish on the outcome. How credible is all this talk about synergy?
The CEO, John Wren, he was resolute. He specifically said they are highly confident in exceeding the synergies they originally promised.
Highly confident. That's a strong phrase, especially when a stock reaction suggests the market is, deeply skeptical.
It is. But what's fascinating here is that the integration teams have apparently been developing these incredibly detailed operational plans. It suggests they found not just places to cut overlap, but maybe even areas for revenue synergies they hadn't initially accounted for.
Okay, so they feel prepared. They think the moment the deal closes, they could just flip a switch and combine functions like finance, HR, IT.
That's the plan. That advanced planning allows them to move, they believe, faster than the market might be expecting.
Before we move off the balance sheet, because a deal this large has to put pressure on cash flow, what do we see there?
Free cash flow was indeed lower year over year. That's just the immediate non-negotiable consequence of those massive acquisition costs hitting net income. But the overall balance sheet is still strong. And importantly, the company still expects to spend close to $600 million on share buyback for the full year.
So they're using this period of sort of integration friction to buy back their own shares. That's a signal of confidence in their own long-term value.
It is a very strong one.
All right, let's pivot to the underlying business drivers now, separate from the IPG drama. We need to know which segments are pulling the wagon and which are hitting the brakes. What was the engine of growth in Q3?
The clear engine of growth is still media and advertising. That discipline just led the pack with an exceptional 9.1% organic growth figure.
9.1%. That's very strong.
It is, and it was driven by strength across pretty much all geographies. Clients just keep focusing their spending on efficient, measurable media.
And I assume that 9% growth ties directly into their big innovation story right now, which is the agentic framework and AI integration within Omni Plus.
Oh, absolutely. And this is where it gets really interesting. Management said that the agentic framework and the generative AI layer within their Omni Plus system, it's now the fastest growing platform in company history.
So how are they monetizing it? It's not just about making ads faster, right?
No, it's about selling efficiency as a premium product. Take the new business win they highlighted with a large automotive company. The integrated AI agents handled consumer research, creative concepting, customer journey planning, everything.
And the result for the client was?
Management reported that the platform cut the lead time on complex consumer research by close to 40%. I mean, that is a tangible, sellable reduction in time to market. Clients will pay a premium for that because it's a real competitive advantage.
And they had a similar story in their health group, right? Something about regulatory efficiency.
Exactly. Their health group is using this AI-first approach to rewrite complex drug launch processes. In a highly regulated space like pharma, integrating Gen AI at the start of development helps ensure compliance and efficiency. It basically speeds up the whole commercialization timeline. It's moving way beyond just creative services.
So media is booming, accelerated by AI. Now, for the other side of the coin, the areas that acted as a drag on that overall 2.6% growth, there were some pretty big pockets of weakness.
There were, but they came with some very specific context, mainly difficult prior year comparisons. Public relations declined 7.5%, but management clarified that about 80% of that decline, a substantial $25 million, was because they were comparing against U.S. national election revenue from Q3 of last year.
Right. The political spending was a one-time spike. The comparison was never going to be easy.
Never. And it was a similar story for experiential, which saw a double-digit decline.
How much was that down?
Experiential fell 17.7%. And again, this was because of a really challenging comp against the Summer Olympics in 2024. When you look at just those two, PR and experiential, you see how much event-driven spending in the prior year skewed these results downward.
Okay, what about precision marketing? That's supposed to be a core growth area for the future.
And that growth was, I'd say, worryingly slow. It crept up just 0.8%. This softness was specifically blamed on declines in their Cordera consulting business, which is their public sector and government consulting arm. It was directly tied to government work cutbacks in some European countries.
And healthcare was also a little soft.
Down 1.9%, yeah. Partly due to spending declines on client products that were coming off patent protection, which usually means a smaller marketing budget.
The geographic mix was also pretty wild, suggesting a real multi-speed global economy. The U.S. was strong.
The U.S. continued its strength at plus 4.6% organic growth. But the real standout performer was Latin America. It grew a remarkable 27.3%. Just an explosion driven by new business wins and a high-spending consumer goods client base.
And conversely, Where were the global soft spots?
Continental Europe was soft, contracting by 3.1%, and APAC was also down by 3.7%. So this unevenness, combined with those event-driven comps, is what ultimately landed the overall growth rate at that 2.6% number.
Okay, let's connect this all back to the broader investor context. Management gave some color on Q4 visibility, which is key because the stock often trades on what's next.
It does, and they reaffirmed their low single-digit organic growth trajectory for the full year. But, and this is a big but, they also quantified how much their Q4 performance really hinges on closing discretionary spending from clients.
How much are we talking about?
They said there's still $200 to $250 million in potential project work up for grabs. That is a huge swing factor for the quarter. Their final 2025 number is really going to depend on whether their agencies can close that work by December 31st.
And they also push back on the idea that their 2.6% growth indicated some kind of weakness, right?
They did. They wanted to really assure investors about the underlying health of the core business. Management explicitly pointed out that if you were to exclude last year's revenue from the Olympics and the U.S. election, this quarter's organic growth would have been around 4%.
So 4%, that signals the underlying fundamentals are performing quite well, just hiding behind some noisy quarterly comparisons.
That's the argument they're making.
And even though they can't pitch together formally yet, what was the early client feedback on the combined Omnicom IPG offering?
They said feedback has been encouraging and very positive. So even though they have to pitch independently until the deal closes, clients seem to be excited about the potential combination of scale and services. It's a strong leading indicator.
Finally, for investors who need that clarity on what the combined company will actually look like, when can they expect more detail?
We won't get the full roadmap until early next year. They're setting the initial disclosure for the week of CES 2026, which is in early January. Then they'll confirm the 2026 synergy amounts sometime between CES and the year-end earnings call. So early 2026 is when investors will finally get that detailed picture they're waiting for.
Okay, we've laid out the core conflict here. Near-term pain versus long-term gain. The integration costs are real, but the synergy promise is vast. So now for our This Is Not Financial Advice segment. If you had to put money behind this thesis, what's the purest way to play this exact moment of uncertainty?
Right. And here is where we have to remind you that nothing we say here should be taken as individualized investment advice. We are simply sharing an outrageous but plausible trade idea based on the dynamics from this call.
Understood. So, based on the market's focus on short-term costs and management's confidence in the long-term synergies, what's the play?
I am pitching a barbell trade that is focused squarely on the IPG acquisition timeline. Given the market's near-term fixation on deal costs and margin compression, the immediate sentiment is fragile. So there's an opportunity to play the downside jitter.
Okay, so the short leg of the barbell, betting against those immediate costs.
Exactly. We short OMC shares in the near term, holding this position until, let's say, the Q4 print in early 2026. The idea is to capture any final integration expense jitters that might show up before they lay out the full synergy roadmap at CES. That margin compression could easily continue into Q4.
And the long leg of the barbell, betting on the ultimate success of the deal.
Simultaneously, we buy long-dated call options expiring in mid-2026 or even later. This is a pure, leveraged bet on the big structural story. The deal closes, the synergy upsides come through and exceed the promise like management hinted, and the AI platform drives sustained margin expansion as those one-time costs roll off in 2026.
So you're leveraging the short-term pessimism while maintaining exposure to that huge multi-year catalyst. It's a pretty sophisticated way to play the uncertainty gap. Let's bring this all home.
The core theme remains. OMC delivered a solid financial beat driven by a strong U.S. market and a dominant media division. However, the story right now is completely dominated by the integration expenses and the promise of the IPG deal closing in late November. Media is strong, boosted by real AI adoption, but PR and experiential were a drag because of those tough comps.
So what does this all mean for you, the listener? Omnicom is making massive, painful moves right now to build scale in the three areas they believe offer the most future growth: media, healthcare, and precision marketing. They are betting nearly $100 million in upfront costs that this combined scale will be unbeatable.
And the final provocative question for you to consider is this. Will the rigorous cost discipline required to integrate IPG and the synergy realization they're promising, will it be enough to close the valuation gap with their peers who have frankly outperformed OMC over the last year? The next quarter, when the combined entity starts reporting, that will be the proving ground for this whole high-stakes thesis.
We've given you the numbers, the context, and the strategic roadmap. Now it's time for you to connect the dots. Thanks for diving deep with us.